Hi everyone, I'm Kathleen with BK Forex. There's been a lot of talk about Japanese currency intervention. So this week I want to talk about central bank intervention, what it means and how to trade it because fundamentals matter. I traded in the direction of potential Japanese intervention numerous times this week, catching great trades like this one in CAD yen. I'm going to outline 3 ways to trade central bank intervention. But before we get to it, there's some basic things you should know about intervention. First, some central banks are always intervening in their currency to maintain a peg or a fixed value. But the central bank intervention that we're talking about are the rare ones that happen when a government becomes uncomfortable with this exchange rate. Let's consider why an excessively strong or weak currency may be problematic. For a country that relies on exporting, a strong currency makes their goods more expensive to importers from other countries. Most central banks of exporting countries like Japan will intervene or come into the market to sell and reduce the value of its currency when it becomes too strong. But there are also times when countries will intervene to prop up the value of the currency when it is too weak. This happens if there's a crisis of confidence in the currency or the country. And if inflation is too high and policymakers are worried that a weak currency will drive prices higher. And that's the problem that the Japanese are facing right now. To influence the exchange rate, central banks start with verbal intervention, hoping that threats of physical intervention would be enough to halt a currency's one-way move. Now, if that doesn't work, then they turn to physical intervention. So how does the central bank intervene in a currency, you may ask? The answer is simple. They'll call up the local banks and instruct them to buy or sell large amounts of the currency. Intervention can lead to quick and powerful moves in currencies. We're talking about 150 to 400 pip moves in a matter of minutes. The timing is always a surprise because the point is to catch the market off guard in the hopes of stopping out traders betting against them and magnifying the move in the process. The direction, however, is always known in advance because of the trend of the currency as well as the verbal intervention. To give you a sense of the move, the last time the Bank of Japan intervened in the Japanese yen was in 2011. They came to the market to buy dollar yen, which hit a record low, putting Japanese yen at a record high. On that day, intervention efforts drove dollar yen from a low of 75.57 to a high of 79.50, almost 400 pips. I dug up my intraday quotes from back then and charted it, showing you how fast the move was. 90% of the move happened in the first 35 minutes of intervention. You can see the extent of the overall move in this daily chart from 2011. I also want you to notice that the 2011 move did not last. This chart shows Japanese intervention in August and March of that same year. The only effort that worked where the reaction lasted was where other central banks like the Federal Reserve and the Bank of England and the European Central Bank were involved. Since 1985, the Japanese have actually come into the market 14 times to buy or sell its currency. Only 7 were successful, and all but one was a joint effort. So there are 3 ways to trade intervention. The first is to bet on intervention happening. That's exactly what we did this past week. The Japanese government had been warning for weeks about the discomfort with the weak yen and threatening intervention to prop up its value. CAD yen had a beautiful zip sell signal. We also sold Aussie yen, which was in its zip sell zone, and rode this move that you see in this chart in the process. The second way to trade intervention is to fade it. We haven't had the opportunity to do so yet, but as you've seen in this example of dollar yen in October and August of 2011, and this Euro-Swiss peg in 2015, big moves like these do not have continuation. You can buy on the close of the daily candle and ride the move for 100 pips or so, but don't be greedy. The third way is to only take trading signals in the direction of the potential central bank intervention, which is what we did in CAD yen, Aussie yen, and Swiss yen trades this past week. Also, always use a stop when intervention is a risk, especially when you're holding overnight positions. But I must warn you that when there's intervention, your stop prices may not be honored. There will probably be significant slippage, which is why it's much better to trade in the direction of potential intervention and not against it. Fundamentals matter. I use it to trade in combination with my zip strategy. I hope this video helps you get a better understanding of how to manage your trades and positions ahead of what could be the most volatile day for the Japanese yen in a decade. Make sure you hit the subscribe button if you don't want to miss content like this and you'll enjoy what you're watching. And if you want to learn how to make pips using Zip and my Zip strategy, there's a link in the description of this video offering you a nice little discount.